Welcome to Future Business School. In today's session of our Daily MBA series, we're diving into financial accounting. This is one of the core pillars of any business education and critical for understanding how companies track and report their financial performance. Today, we'll cover balance sheets, income statements, and cash flow, giving you a solid foundation in financial accounting basics. Let's get started. What is financial accounting? Financial accounting is the process of recording, summarizing, and reporting the financial transactions of a business over a specific period. It provides a clear picture of the financial health of a company and is used by internal management, investors, creditors, and regulators to make informed decisions. The key outputs of financial accounting are financial statements, which include balance sheet, income statement, and cash flow statement. These three statements together give a comprehensive view of a company's financial performance and position. The balance sheet. The balance sheet shows the financial position of a company at a specific point in time. It's divided into three sections: assets, what the company owns; liabilities, what the company owes; and equity, the owner's stake in the company. The balance sheet must always balance, meaning assets equals liabilities plus equity. Assets equals liabilities plus equity. Assets are resources owned by a company. They can be current assets, which are short-term assets expected to be converted into cash within a year, such as cash, accounts receivable, and inventory. And then we have non-current assets, which are long-term assets like property, plant, equipment, and intangible assets, such as patents and trademarks. Liabilities represent what the company owes to others. They are divided into current liabilities, which are debts due within a year, like accounts payable and short-term loans, and non-current liabilities, which are long-term debts like bonds payable or long-term loans. Equity is the owner's claim on the company's assets after all liabilities have been paid. It includes common stock, which is the initial investment from shareholders, and retained earnings, which are profits that are reinvested in the business, which equal. Real-world example, Apple Inc. In Apple's balance sheet, we can see assets like cash reserves and product inventory, as well as liabilities like accounts payable and long-term debt. Apple has one of the largest cash reserves among corporations, giving it flexibility for investments and acquisitions. The income statement. The income statement, also known as the profit and loss statement, shows a company's profitability over a specific period, monthly, quarterly, or annually. It tracks revenue, expenses, and profits. The basic structure of the income statement. Revenue minus expenses equals net income. Key elements of the income statement. Revenue, also called sales or income, is the total amount of money a company earns from its business activities. For example, Apple's revenue comes from selling iPhones, iPads, and services like iCloud. Cost of goods sold, or COGS, includes the direct costs associated with producing goods or services sold by the company. In Apple's case, COGS includes the cost of manufacturing iPhones, software development, and more. Gross profit is calculated as revenue minus COGS. It shows the profit made after deducting the costs directly tied to production. Operating expenses include costs not directly tied to production, like salaries, rent, and marketing expenses. Operating income is calculated as gross profit minus operating expenses. It shows the profit from normal business operations before interest and taxes. Finally, net income is the amount left after accounting for taxes and interest, representing the company's total profit or loss during the period. Real-world example. Amazon. Amazon's income statement reveals how its revenues have skyrocketed due to its dominance in e-commerce and cloud services, also known as AWS. Despite high revenues, Amazon's net income can sometimes be lower than expected due to its reinvestment in logistics, research, and technology. The cash flow statement. The cash flow statement tracks the flow of cash in and out of a company over a specific period. Unlike the income statement, which can include non-cash items like depreciation, the cash flow statement focuses strictly on actual cash transactions. The three sections of the cash flow statement. Operating activities. Cash generated or spent in the core business operations. This includes cash received from customers and cash paid for expenses, salaries, and suppliers. For example, for Tesla, operating cash flow includes cash received from vehicle sales and cash paid for employee wages and material costs. Investing activities. Cash spent on or received from investments in long-term assets. This includes the purchase of machinery, equipment, or investments in other businesses. For instance, a company like Google investing in new data centers or acquiring startups. Financing activities. Cash flows related to raising capital or repaying debt. This includes issuing shares, borrowing loans, or repaying loans and dividends to shareholders. For example, a company issuing bonds to raise money for expansion. Positive cash flow is essential for a company to maintain operations, invest in growth, and pay off debts. A company can be profitable, but still run into trouble if it doesn't manage its cash flow properly. Netflix, during its massive growth phase, had negative cash flow because it was investing heavily in original content. Although it had growing revenue and subscribers, it was spending more cash than it earned, which it funded through debt. Balance sheet versus income statement. The balance sheet shows a snapshot of the company's financial position at a given point, while the income statement covers a period, tracking profitability. Income statement versus cash flow statement. The income statement may show profits on paper, but the cash flow statement reveals if the company is actually generating cash. Non-cash items like depreciation affect the income statement, but not the cash flow statement. Key ratios in financial accounting. Financial ratios are used to evaluate a company's performance using data from its financial statements. Here are three essential ratios. Current ratio, which is a measure of liquidity. The formula is current ratio equals current assets divided by current liabilities. This ratio measures a company's ability to pay off short-term obligations. A ratio above 1 suggests good short-term financial health. Next, we have the debt-to-equity ratio, which is a measure of leverage. The formula is debt-to-equity ratio equals total liabilities divided by shareholders' equity. This shows how much of the company is financed by debt compared to owner's equity. A high ratio indicates higher risk. Lastly, there's the return on equity, or ROE, which is a measure of profitability. The formula is ROE equals net income divided by shareholders' equity. This ratio shows how efficiently the company uses shareholders' money to generate profit. Microsoft consistently shows strong return on equity and a healthy current ratio, signaling both profitability and a strong ability to meet its short-term obligations. Its low debt-to-equity ratio shows the company relies less on debt financing compared to other tech giants. Financial accounting plays a crucial role in decision-making for various stakeholders. For managers, it helps in budgeting, controlling costs, and making strategic investments. For investors, it assists in assessing the profitability, liquidity, and risk of a business before investing. For creditors, it helps in evaluating the company's creditworthiness and ability to repay loans. And for regulators, it ensures transparency and compliance with accounting standards and laws. In summary, financial accounting is essential for understanding a company's financial health. By analyzing balance sheets, income statements, and cash flow statements, we can assess a company's profitability, liquidity, and overall financial stability. Whether you're managing a business or investing in one, these financial statements provide valuable insights. Thanks for watching. Please like, share, and subscribe to Future Business School for more valuable business insights. Stay tuned for our next session on financial statement analysis, where we'll dive deeper into interpreting these financial documents.